It is our great pleasure to welcome Professor Avanidhar Subrahmanyam from UC Los Angeles as our first plenary speaker in StatFin 2022. Professor Subrahmanyam is going to talk about momentum and will give our conference a momentum, I'm sure. So without any more ado, because we are already lost a few minutes, I will invite Professor Subrahmanyam to start his lecture, which will be a 1-hour lecture with some time for questions and answers and other interactions. So Professor Subrahmanyam, the stage is yours.
Thank you. Thank you very much. So I plan to talk for about 40 to 45 minutes, and then we can have a Q&A. So I guess I know this conference is about statistical methods, but I think that the statistical methods used in this paper are useful for testing a specific situation that arises in finance. So hopefully it will help in that dimension. So this paper is co-authored with 2 other people of Indian origin. As you know, one of them is Narasimhan Jagadish, who essentially is the discoverer of a very important phenomenon in finance, which is in fact momentum, that we'll come to in a minute. And Amit Goyal is also a well-known scholar in Europe. So it's my honor that I've been able to co-author this paper with those people, including particularly the father figure for momentum, Jagadish, with Sheridan Titman, who actually discovered this phenomenon. Okay. So in this paper, we are concerned with the issue of why do we see momentum? And to motivate that, let's take a look at all of this. So, as you know, stock market momentum violates the basic weak form efficiency in financial markets. And the phenomenon refers to the notion that stocks that perform well in the previous 6 to 12 months repeat relative performance, which is the basic idea that the stocks that have done well in the past 6 to 12 months relative to other stocks continue to outperform those stocks going forward as well, right? So if you sort portfolios by past performers into winners and losers, for the next 6 to 12 months after you form the portfolios, you get a similar performance ranking. The winners do well and the losers do badly relative to each other. This is a very simple anomaly, right? And when you teach your students prices are weak form efficient, well, unfortunately, this particular phenomenon violates the weak form efficiency part of it. So you start to wonder what's really going on. Because of the simple nature of the anomaly that history repeats itself, Fama and French in 2008 called it the premier anomaly in stock returns. They say, like, we really can't really understand where it comes from, and it's really very strong in the data. The problem with momentum, though, is that if somebody were to ask us, why do we see momentum, and a practitioner were to ask us, why do we see momentum? After 28 years, our answer is like, we just don't know, right? So academics have not been able to discover a cause for this phenomenon, which creates the difficulty for us as academicians. So the question that arises is, why indeed do we see momentum? Okay. The problem is that we have no consensus among academics, but we have many explanations for momentum, at least 6 different explanations by different sets of academicians. But we still don't know which is exactly the right explanation. Everyone has their little theory, but empirically speaking, we don't really understand why it arises. Now, there are 6 different explanations, as you'll see, at least, okay? The problem, however, is that there's a specific nature of the predictability over 6 to 12 months. It doesn't work over horizons of 2 years and 1 month. It works over horizons of between 6 to 12 months. And it's such a specific form of the anomaly that history repeats itself. Winners continue to outperform losers going forward. It's unlikely that this thing is caused by all these drivers equally. I mean, really 6 theories for the same thing seems unlikely, right? So the question that arises is, which of these explanations is robust and what's really happening as far as momentum is concerned. And surprisingly, academics have paid very little attention to that important issue, which is basically where our paper comes in. As far as the issues surrounding those explanations, the 6 explanations are concerned, we do have a lot of pressure by academics to confirm their own theory. And to develop a theory, you want to confirm it. And so what we see is that the explanations are being tested using different methodologies. So each explanation is tested using a different method. And there's obviously a subconscious bias to confirm the theory, which applies to the academic who actually develops the theory. If you develop a theory, you have a bias to confirm the theory. So there's inadvertent p-hacking concerns where you sort of, in some sense, look for the p that works for you, and then stop, the stopping rule, right? You get this result you want, you shut it down. So what's really needed in this particular case is that we need to examine the empirical proxies for the explanations on common footing. That is, say, use a common method to test all the 6 explanations and the same exact data, right? And preferably, you should test the whole 6 stories out of sample, right? Not in the sample that was used to confirm the theory, which is important because otherwise you'll be susceptible to the notion that you're not going to be able to tell which one's better. So our goal here is to figure out which of these explanations is in fact the true explanation. Now, in presenting this paper, we want to ensure that we understand that we're not really saying that any of these researchers did anything wrong, but we're just trying to get at the root cause of momentum. That is to say, everyone probably has the best of intentions to develop their own explanation and test it. But what we really want to get at here is, without casting aspersions on anyone, what's really going on as far as momentum is concerned. Okay. One other point I wanted to make was that we want to essentially use previous proxies. So we're not going to, develop our own explanation in this paper. That's not the goal of the paper. The goal of the paper is to simply test for which of the competing explanations is actually robust. So we're going to use the proxies that explain momentum that were developed in those papers. We're not going to come up with our own proxies. The reason is, if we did our own explanation and our own proxies to explain momentum, then people would say that you did p-hacking too. You wanted to confirm your explanation, so you just come up with a story, right? And some tests. So the biases that apply to all the previous theories, we don't want them to apply to us. So that's what we're going to do. We're not going to develop any new explanations. Okay, so moving on. So here's what we do in this paper. First, we consider that momentum is an international phenomenon. It's not just restricted to the US. It holds in a large number of countries across the world, particularly in Europe and also the subcontinent and so on and so forth. So what we're going to do is to do an analysis out of sample and use only international data. Now, why only international data? By only international data, I mean non-US data. And the reason is that all the explanations that exist so far were developed for the US. So if you want to use out of sample, the logical thing to do is to go international. So this paper will not have United States data, it's only international data. And also what we're going to do is to do a horse race of various explanations, which essentially means we're going to essentially test all the explanations on a common footing and see which one wins. That's the logic behind this particular work. Okay. So now let's get into the issue which requires some understanding of intuition. This is where we kind of depart from econometrics. The reason I have to present all this information is because we're going to test for all these explanations, and so we need to know where they're coming from. So like I said, momentum is a single phenomenon, but the explanations for the phenomenon are several. And so, as I said, at least 6. So let me present the explanations first and then talk about the empirical measurement for the explanations on the next slide. So here are the explanations. So one class of stories says that momentum arises due to overconfidence. And so the logic there is that if somebody invests in a stock, this price goes up, and that investor gets good information about the stock, they buy more stock, so the price goes up more. But if they get bad news about the investment, they don't want to recognize that they made a mistake, so the price doesn't go down, they don't sell, right? So on average, the price keeps going up. It's continuing overreaction, right? If you buy a stock, you get good news, you buy more stock. You buy a stock, you get bad news, you do nothing. You don't sell because it creates a dissonance in your mind that you're a bad investor. You don't want to admit that, so you don't sell. So the price keeps going up. A symmetric argument is on the sell side. So that's the explanation, okay? So that's one explanation. Another explanation is slow diffusion of information, which suggests that people don't condition on all available information. People underreact to information signals. That's why we see momentum. For example, people don't condition on information conveyed by market price. And so they ignore that, and you're going to have momentum because people don't incorporate all available information correctly, and prices just drift. Explanation number 3 is based on a psychological bias called anchoring. And anchoring refers to the fact that people condition on irrelevant information to form judgments. And the idea used in this explanation is that when prices are close to historical highs, say 52-week high, right, then people think the stock's too expensive and the market underreacts to good news because people say the price is already very high, it can't go up anymore. So when good news comes out, people underreact to it, okay? That leads to momentum. All right, so that's number 3. And I'm going to go through this really quickly because the explanations are not the focus of the paper, the testing is. But 2 more to go. One other explanation is limited attention or frog in the pan. Let me come back to frog in the pan in a bit. But basically, the idea behind limited attention is that if the news about the stock flows slowly in little bits, then people don't notice the news, okay? So the stock price underreacts to such news. Whereas if the news about a stock flows in chunks, big pieces, then people react properly to it. So the reason momentum arises is because people underreact to information that flows in small chunks, small bits, as opposed to large chunks. The reason the analogy is with frog in the pan is because essentially, if you put the frog in a pan and bring the water slowly to high temperatures, the frog doesn't react properly to it. Putting in boiling water will jump out, but you heat up the pan slowly and it won't notice it. So that's the logic in the analogy, okay? So that's because you can already see there are 4 explanations. There's a 5th explanation, which is something that we base it on real options, okay? So real options are simply projects that the firm has the option to take on. And basically the logic behind this is that stocks with low costs, like cost of goods sold basically, are stocks with high operating leverage, like we teach MBAs, and they have more real options, more real investment opportunities when prices have gone up, okay? So when prices have gone up, it means that essentially the firm has more things, options it can invest in, which means that they're more risky and they have greater required returns because each option adds to risk. So the more investment opportunities you have, the more risky your company is, which means that you have greater required returns. So the idea is when prices go up, you have more investment opportunities, which means you're more risky, which means the future required returns in the company are greater, and therefore you get momentum, right? Prices go up, greater required returns means momentum. You can see there are 6 explanations here. All 6 exist in the literature, but somebody were to ask you, well, which one is correct? And we don't know because nobody really tests them against each other. Everyone has their own individual story. So that's where we come in. So what we're going to do now is present the empirical proxies for each explanation as adopted by the authors. And then what we're going to do is to go and test them. Right, so now let's talk about the empirical proxies. Remember, I presented to you just the theories. What are the empirical ways that the authors that invented these theories actually capture? So let's talk about the overconfidence story. The level of overconfidence was captured by the book to market ratio of the company. The reciprocal of book to market, market to book, captures the level of overconfidence. Okay. And so the logic behind this idea is that when market to book is high, right, then essentially there's more uncertainty surrounding the firm. It's like a growth firm, right? Which means that overconfidence is more likely. Okay, so overconfidence about a riskless asset is not applicable because the rate of return is known. Okay. Right. So could you please, whoever is unmuted, could you please mute your signal? Because I'm getting an echo. Thank you. Thank you very much. All right, so market to book means more uncertainty, and therefore overconfidence is likely to apply more, because overconfidence for a riskless asset doesn't mean anything. There's nothing to be overconfident about, for example. Okay, that's that. The slow diffusion of information is captured by these authors, Hong, Lim, and Stein, by analyst following. And so the logic is that information diffuses more slowly when analyst following is low. Okay. Really quickly, the level of anchoring is captured by the ratio of the current price to its 52-week high, which is when anchoring is expected to be greater, like I already told you. Okay. Now, here's something that I need to explain a little bit. The frog in the pan story, which essentially is the notion that the market underreacts to small bits of information, is measured by a variable by these authors, Dagrun and Rajka, by a variable called ID. Let me explain to you what ID is. ID is the following variable. You measure the momentum return, which is the return of the past 6 to 12 months, right? Then you calculate its sign. What's the momentum return sign? Has the stock gone up or down over the past 6 to 12 months, okay? Then you multiply it by the number in brackets, which is the difference between the percentage of the daily returns that are negative over that momentum period and the percentage of daily returns that are positive, okay? Now, how does this measure news arrival? Let's suppose that the sign of PRAT is actually negative, right? And the number in brackets is also negative. That is to say that the number in the brackets is positive, so that there are many more negative news days than there are positive news days, right? Okay, so the total product will be then positive because the sign of the return is negative and the number in brackets is, okay, sorry, apologize. Suppose the sign of the PRAT is negative and the number in the brackets is positive, so the negative news days exceed the positive news days. Then the product will be negative, right? Which also is consistent with the notion that information came out in small bits, because that means that the negative sign on the PRAT is driven by the percentage of negative days, right? Because the difference is positive, which means many more negative news days. So the information came out in small chunks, right? And a similar argument applies for the upside as well. So when this whole product is actually negative, it means information arrived in small bits. And when that number is positive, it means more discrete news arrived, given by the example I gave you, right? The example is that if the sign is negative and the number in brackets is positive, negative news days exceed positive news days. That means that information arrives slowly in small chunks over the days, or negative news days, and vice versa, right? So high ID implies more discrete news arrival. That's the logic. Okay, as far as the real options story is concerned, these guys, Sagi and Seashoals, measure it by cost of goods sold. And the argument is that when COGS is lower, the cost structure is lower, then essentially you have greater operating leverage and so on and so forth. So basically the idea in this case is that there are more real options when cost of goods sold is lower. That's the logic they use. I'm going through these explanations really quickly because these are not what we invented. They were invented by the original authors. Okay, then that's the logic. Okay, so now the issue is that all these momentum explanation studies that I just mentioned were done using US data. And so what we're going to do is to use international data. It's an out-of-sample study. So these explanations are going to be tested on data that essentially is out of sample. Okay, so now let's get into the data before we get into the method itself. Essentially, in this data, we're going to have all countries in the developed MSCI developed index, excluding the US, and the MSCI emerging market index. So it's going to be 22 developed markets and 27 emerging markets. And then the data set is going to span the years 1993 to 2020. I'm not going to say anything more about the data set. That's pretty much it. And really quickly, these are the developed countries and the emerging countries that are going to be used in this study. They're also listed in the paper itself. So All right, so what's the objective? Let's make sure we understand. The objective is to figure out what's really causing momentum. Right? There's 6 explanations, 6 proxies, and we want to make sure that we understand which of these proxies is really driving momentum. So first we'll tell you how we measure the momentum return, that is, say, the past return. Okay, so we're going to measure the momentum return using the past 11 months of data, excluding the most recent month. And the reason is that there are monthly reversals in stock market data. We want to exclude those. So that's how we're going to measure it. Different countries have different situations, financial market development, so on and so forth. So we're going to country neutralize the momentum return when we actually use it. In other words, we're going to run one big analysis across all countries. We're not going to run a country by country analysis. To accomplish that, we're going to country neutralize the momentum variable, which means that we're going to use the momentum variable, subtracting the cross-sectional mean for each country. So that helps us in running the test on the entire set, the global market data set. Okay. And then in some of the tests, we'll use momentum deciles. So what we'll do is that we'll divide up stocks by the momentum return of the past periods. And then what we'll do is that we'll sort stocks into winners and losers, and then take the difference between winners and losers. We're going to evaluate the resulting winner minus loser portfolio. And there's some standard stuff we do. International data is prone to errors. So we're going to Winsorize the data as well. So let's get into the results now. The very first thing I'd like to point out is that if you look at the actual momentum return over the past 1993 to 2020, and look at the return on the WML portfolio. Now, the return on the WML portfolio is calculated as follows. You sort stocks into winners and losers, and then measure the return in the next period after the formation, right? And calculate the difference between the winner portfolio and the loser portfolio next period. So you're predicting the future return using the past momentum return. And as you can see, for the 3 groups we consider, all markets excluding the US, developed markets excluding the US, and emerging markets, you see momentum in all 3, right? So essentially, the magnitude of the momentum return, which is the first row of this table, is similar across all 3. It's also statistically significant, and the reason is that if you look at the standard deviation, the t statistic is the mean divided by the standard deviation over the square root of the number of observations. There are about the square root of the number of observations are approximately 18, because we have 27 years of data and multiplied by 12 for the monthly data, and then take its square root. And so if you divide 64.8 by 18 and then take 10.7 and divide it by that, you get significance. So there's significant momentum returns in each of these markets. So now that we've confirmed that, let's move on to talk about the basic regression method that we use as our methodology in this paper. So what we're trying to do, as I said, is trying to figure out which of these proxies explains momentum the best, right? So the regression we run is the following. The return next month is regressed cross-sectionally, Farmer-Beth style, on the momentum return variable, right? We're trying to predict future returns using momentum variable. Also on the proxy X. The proxy is just one of the 6 or 7 variables I described earlier, okay? And then the key variable for us is momentum times X, which is the interaction of momentum with X, which essentially tells us the degree to which X explains momentum, right? So it's the interactive variable, the gamma-3 coefficient, that's essentially the key. Okay. And so let me just give you the results. I think that's the best thing to do in this case. So all we're trying to do is to run a horse race. And we think this methodology also is useful, even though it's simple, that when you're trying to understand which of a series of variables is causing something, this is the kind of regression that we should be running. So what we've given you here is simply the coefficients on the proxies. Now, what are these proxies? If you see the very first row, the book to market ratio, turnover, analyst following, 52-week high, the frog in the pan ID variable, the cost of goods sold, and another proxy for real options that is suggested by the authors, which is simply return volatility, when there's more return volatility, you have more, it suggests more investment opportunities, more risk, and greater return. That's the general idea. Of these proxies that we have here, the most robust variable is in fact ID. It is the most significant. We'll have more to say about that. But before we go any further, we also have to discuss with you some issues related to the sign of the variables. So you can see that the column 4 is actually significant. The mom star X is actually significant. But the important thing to note here is the sign is wrong. So when analyst following is high, news should diffuse faster and there should be less momentum, but we find the opposite result. So that sign of the coefficient on column 4, analyst, doesn't conform to the explanation, so we have to discard it. We told you earlier that high ID means more discrete diffusion of news, and low ID means slower diffusion of news, right? News coming out in small bits, and that's consistent with what you find. ID has a negative coefficient, right? So the most robust coefficient is just ID, as you can see, the frog in the path, ID variable. So if you do it by subsample, first half, second half, we again find that ID is in fact the most robust variable. Okay, so that's also satisfying and reassuring. There are some countries that actually don't have any momentum, like China, Japan, and Korea. So what we did was we excluded the countries without momentum, and then we again ran the regressions. In this case, we normalized the signs of the X variables so that the predicted coefficients are all positive, because some of these proxies suggest a negative sign, some suggest a positive sign, so we normalize them to be positive. Once again, we found that ID was the most significant variable, and so the result is basically robust. Okay. We also did some non-L2 techniques. So the non-L2 techniques can be described as follows. Let's say you have a loss function, which is the OLS loss function, okay? And then you can tack on an additional penalty function, phi of theta, where L of theta is simply the OLS loss function, and the phi of theta is an additional penalty you impose, and theta is the parameter set, right? So the basic story that we're trying to do here is to apply elastic net and lasso. So the loss function, the phi function, for elastic net can be described as follows. It's that functional form right there. And so in that functional form, where theta is the parameter set, right? When rho equals 1, you're applying a convex penalty on large parameters, which is ridge regression. And when rho equals 0, right, the first term applies and the second term is 0, you apply a penalty on very large parameters in an absolute sense, not in a convex sense, right? And so that's called lasso. So what we're going to do is that we're going to use lasso and elastic net with rho equals 0.5 and run regressions of the same type, like that. So as you know, in lasso, some variables can be totally discarded, thrown out. But when you actually do the lasso or the elastic net and compare it to OLS, particularly for the ID variable, the coefficient estimate barely changes, right? Which means that it's not a redundant variable, it's a fairly stable variable. And that's all I wanted to point out there, right? You can see that the coefficient is fairly stable and clearly it doesn't get thrown out. So for lasso, elastic net, everything. And so in multivariate regressions, ID is the only robust interaction with momentum. Let me then propose to you one other thing that we do, which is that we just ran a horse race and found that the ID variable, right, frog in the pan, ID variable, is in fact the most robust variable. But what we want to do next is to do a bilateral test. That is to say that we want to make the explanations compete with each other in a bilateral sense, which we call boxing matches, right? So here's what the methodology we use for that. So what we do is that we regress future returns on past momentum returns, and 2 variables at a time. Just 2 variables pairwise taken at a time, right? And that's the boxing match. So in these cases, you'll have 2 interactive variables. One of them are interacting momentum with x1, which is the first one, and the second one interacting momentum with x2, which is this momentum star x2. So gamma 3 and gamma 5 are the two effects, right? And we want to test for whether gamma 3 exceeds gamma 5, which means we want to see whether x1 or x2 wins the boxing match, right? Two at a time. So what we're going to do is to run this regression and report gamma 3 minus gamma 5 with a test of whether it's different from 0. Okay, that's what we're trying to do. Okay, so the result of this boxing match, where we run every pairwise x1, x2 regression possible, is actually also very reassuring, because ID actually wins the boxing match in every case. So you can see that in the column, ID versus any of the other variables. This is just a matrix that describes the boxing match. So 0.144 is the result of ID being boxed with BM, right, for example. So you can see that ID wins every boxing match, right, in this. And the horizontal one for ID versus Cogs and Retval is actually negative. And for the reason is that the boxing match goes the other way, where if we test for x1 equals x2, and here we have a situation where it goes the other way. It's on the row side of the matrix, so obviously the coefficient will flip side. But the fact is that ID wins every boxing match. So again, we get this robust result that ID is in fact winning the boxing match. Remember, we're computing gamma 3 minus gamma 5. So when ID goes into the row, the sign will flip, right? So that's as far as the regression approach is concerned. We also do a portfolio approach, where here's what we're trying to do. We sort stocks based on the X variable, the X proxy, right? And within each of the deciles for the sort by X, we compute the momentum portfolio return, winner minus loser portfolio return, right? And so if a variable explains momentum properly, then momentum return should be higher in the extreme X group, right? And so that's essentially what we test. So as you can see here, basically what we're saying here is that what this variable minus 6.56 means is the following. You sort stocks by ID, right? Then you calculate the momentum return within each of the ID groups, the WML return within each ID group. And then you look at the difference between the momentum return in the high ID group versus the low ID group, right? So if ID explains momentum, then momentum should be higher in one extreme ID group vis-a-vis the other extreme ID group, right? That's what it means for ID to explain momentum. So the minus 6.56 and the significant p statistic means that momentum is higher in the lowest ID group relative to the highest ID group, right? Which is essentially means that ID explains momentum, right? And the result for ID is in fact the most significant yet again. So again, this ID variable seems to be the best at explaining momentum. So that's that. In the remaining part of the paper, we do something on time series properties of momentum, where we confirm some findings from early literature out of sample. So these three authors, Cooper, Gutierrez, and Amit, confirmed that momentum applies only in bull markets. Momentum is higher in up markets, but in down markets, it doesn't work. Then Wang and Su find the result that momentum profits are lower in more volatile markets. And so what we wanted to do is to see if these results are robust, because these two studies were also conducted for the US data. And what we wanted to see was whether these results are robust to the international data as well. Okay, so the tests we run out of sample are that we run a regression of the time series of momentum returns, okay, which means that the WML portfolio returns in the following way. On two variables, up and down, where up equals 1 if the previous 36-month market returns positive, and 0 otherwise. Then otherwise down equals 1. Okay, so, and up equals 0, and so on and so forth. So that's one regression we run. The second regression we run is a similar regression on high vol and low vol, where high vol equals 1 if the standard deviation of the past 12-month daily market return is greater than its past 36-month counterpart. Okay. That matches the original studies. Okay. So again, this is an out-of-sample regression that we run because the studies were done on US data, and we want to see if that works on international data. And so what we find is a confirming result that the momentum return is more significant in up markets, so that we confirm that. You can see that. Okay. And in down markets, the momentum return is insignificant. We also confirm that momentum returns are more significant in low volatility markets and not in high volatility markets, right? You can see that. And that holds for markets, all markets excluding the US. It also holds for emerging markets, right? So that those two results are robust, and we confirm them. Okay, sorry. Okay, so one other thing is that there has been some issues relating momentum to long-run reversals, and people say that momentum is continuing overreaction, and continuing overreaction should reverse itself out. So what we do is that we test for whether momentum profits actually reverse, or whether they represent pure underreaction. So if momentum profits are accompanied by reversals, so the stock that exhibit momentum eventually reverse out, then we would say that momentum is continuing overreaction, which reverses. But if momentum is pure underreaction, as suggested by the ID variable, then momentum profits should not reverse. So we take a look at momentum profits 1 month after the momentum portfolios are formed, 1 to 6 months after, and so on and so forth. And we find that momentum is more significant over the 1 month horizon going forward, but the other variables in the long run are not significant. So momentum profits do not reverse, is all I'm trying to say. Which means that it suggests that momentum represents underreaction as opposed to continuing overreaction. That's what is suggested by this table. Okay, I'm not going to do all these other studies, but one other thing I'd like to point out is that the first part of the paper says that the primary driver of momentum is just ID, okay? And ID is in fact a variable that goes the following way. High values of ID means news information flows in discrete chunks, and low values means that it flows slowly, and there's more momentum and information flows slowly because people underreact more in that situation, right? So the question that arises is whether ID exhibits different behavior in up and down markets, because if we see more momentum in up markets, does that mean ID is actually lower in such markets? And we do find that that's the case. For example, if you look at the average ID in up markets and the average ID in down markets, ID is in fact lower in up markets, right? Which is consistent with the notion that we see more momentum in up markets. That's also true for volatility. You can see that ID is lower in low volatility in high volatility markets, which is consistent with the notion that there's more momentum in low volatility markets, right? So the behavior of ID actually mirrors the behavior of momentum here as well. Okay? So that's essentially the takeaway. So I'd like to again give you the basic intuition behind the paper before I conclude, and then we can take questions. So this is the variable that I wanted to again emphasize for you, this variable on the slide. So the hypothesis by these authors, nothing to do with me, was the following, that if news about a stock comes out really slowly, right, then the market will underreact to it, right? Whereas it comes out in discrete chunks, then people would react properly to it. So you'll see more momentum, underreaction, when information comes out in small bits as opposed to big chunks. And the variable that measures it is this key ID variable. So I want to reiterate the intuition here so that you make sure that we have a punchline here. So this is the ID variable. This ID variable is measured by multiplying the sign of the momentum return with the following number, the difference between the percentage of days on which the return is negative minus the percentage on which days in which it's positive, right? And the percentage is calculated for daily returns, right? So the percentage of days in which the return is negative and the percentage of days in which the return is positive, or measured over the same period over which the momentum is measured. So one more time, the intuition is, let's say this stock went down. So the sign of the momentum returns negative, okay? And the number in brackets is positive. It means that the stock went down on many more negative days than positive days, which means information came out slowly, right? That's the intuition. So high ID means more discrete news arrival, which means that momentum is inversely related to ID. That's the logic they put forth. And that's essentially the main, the variable that we found best explains momentum, for example, in this table and other tables, right? So that's essentially what we found. Now, having reiterated that intuition, what I'd like to do is just conclude, okay? And then we can take some questions. Okay, so the basic idea behind this question we're trying to answer is that why do we see momentum, right? Now, whether we say we then have the final word here or not, we still made an attempt, right? We need to understand why we see momentum. The problem right now in the literature is that there is just way too many explanations and we don't really understand what's really going on. And we can't tell practitioners what is going on. So the virtue of this paper is that we test all these explanations with a common method and a common data set, right? And the data set is out of sample because the existing explanations for momentum are developed in the US. So what we are doing is testing it out of sample, right? So those are the virtues. And the conclusion is that the FIP proxy, which is ID, right? It wins the horse race and the boxing matches handily. And the logic is that due to limited attention, investors underreact to bits of news relative to chunks of news. Momentum profits do not reverse, so they seem to represent underreaction. And momentum higher in up markets and less volatile markets, but the ID measure also is higher in those markets, which is further supportive of the drawing the pan ID hypothesis. That's essentially what we do in this paper. Okay, so I have ended my talk on time, approximately 40 minutes. And at this point, I'm more than happy to take questions if you have any. You can also send me questions on the chat, right? And I'm happy to take questions. That is the end of my talk. Thank you.
Thank you, Professor Subrahmanyam. I think there will be some questions. So are there questions now? Questions or comments? Audience? Yeah, Shorish?
Professor Subrahmanyam, this is Shodish from Chennai Mathematical Institute. I have actually three questions.
Three questions. Better note them down. Hold on one second. Okay, go ahead. Yeah.
Yeah. So the concept of momentum that you are explaining, if I have understood you correctly, that you are essentially working at a monthly level return data, right?
Right.
With typical typical what we teach in our quantitative finance class, take daily return and work on that. So,
okay.
So my question is the concept of momentum, where it stands with respect to explain the concept of, say, or no arbitrage theory or the market efficiency.
Right. So the answer to that question is that as it stands, momentum does not seem to have an explanation that fits with market efficiency or no arbitrage theory, because the simple form in which this predictability exhibits itself is suggestive that it's not consistent with those stories, right? Because market efficiency will mean that markets permit no memory. And no arbitrage would mean that such simple forms of arbitrage should not be allowed. So I would suggest that it's an anomaly. That's why it's important to understand. As you can see, Farmer French, the great economists themselves say that it's a premier anomaly in stock returns. We don't. So I would say that market inefficiency stories are more likely to apply for momentum than efficiency stories. Momentum violates market efficiency, I would say. That's the way that's where we stand right now.
So thank you. I mean, I thought so, and you confirm my, intuition. So I just have another question, which is little technical. That in the main result, where you, if you can go to that slide.
With this one, right? Okay, one second.
Main
So
result where
this one, yeah.
Where you have a table. Yeah. Yes, I think. Yes. I was a bit confused. If you look into the adjusted R square, some of the adjusted R square like 1.0, 2.0. Generally, our notion of adjusted R square will be always between 0 and 1. If you have any comments.
Oh, that's in percentage, boss. Don't worry about it.
Okay.
It's just in percentage points. It's only 1%.
Okay. So,
sorry, you're not going to get 200% R squares. No,
so
it's in percentage points. Yeah.
All right. So out of 100, it's like 2% explanations.
Correct.
So in that sense, I would say it lot of lot of variability is left unexplained, right? If I'm so
sure.
That means there are lot of things needs to be. I think there might be a lot of other variables which might explain the variability. Can I say that?
That's absolutely true. Actually, if you look at the R squares for individual securities, I think that's pretty much what we get. So if you can't get an R square more than 2-3%. There's a lot of noise in individual security returns. If you run the same regression for portfolios, you might get, I don't know if you supply the R squares for that, but if you do the same regressions of portfolios, you might get much higher R squares. But in empirical work, even if you run this regression for India, for example, you won't get more than the R squares we get. So I would suggest that this is pretty much what you get. That's the ballpark for predicting individual stock returns. Very noisy. Individual stock returns are very noisy. So in fact, if somebody gets R square of 10% for individual stocks, you should be suspicious. It's almost impossible.
Well, my experience is if typically the stocks which are on the which are basically part of the major indices like S&P 500 or the Nifty 50 or FTSE or DAX, their adjusted R square tend to be little higher than the rest of the stocks, but other stocks that, as you said, my experience is not more than maybe.
Boss, just hang on. They're supposed to be more efficient. It's the other way around. So Nifty is, see, let me explain to you what's going on. See, if you're trying to predict returns using predictive variables, the R squares tend to be low. If you're trying to contemporaneously explain them with some variables, then that's a different story, right? If you regress stocks on inflation contemporaneously, you can get a high R square, right? But in this case, we're just trying to predict returns, right? We're trying to predict future returns using momentum variables and X variables. Predictive regressions have low R squares. Contemporaneous regressions can have high R squares, but it's important to note that if you're predicting, the Nifty will have lower R square. Contemporaneously, since Nifties react more to macro news, you'll have high R squares. So make sure you understand what the regression is. That's all I'm saying. But your point is correct. Point is correct for contemporaneous regressions.
And the last question that I have, I found that when you were presenting the skewness, kurtosis of the developed market versus the emerging market, I found that emerging market is slightly different compared to the developed market and the US market. So I was just wondering if you can give some intuition about, how, for example, kurtosis, where is for developed market is near about 9, but it is almost half for emerging market. So how we explain that? I mean, what is your intuition behind these numbers?
Okay, so first of all, boss, again, this is momentum returns. Okay, this is not unconditional returns. It's the return on the momentum portfolio. That is to say, let me put it this way: if you sort stocks by past returns, take the differential between the winner portfolio and the loser portfolio, and then calculate the return on that portfolio the next month and average it out. The summary statistics are for that. They're not for stock markets. They're for momentum returns. It's the time series skewness and kurtosis for momentum, right? So all this is showing is momentum profits have lower skewness in emerging markets and lower kurtosis. That's all it's saying, okay? But then the mean momentum is also lower in emerging markets, right? So this is not saying that stock returns in emerging markets are less skewed, negatively skewed. It's simply saying momentum is less negatively skewed, which means that momentum is less prone to crashes and peaks, right? That's all there is to it.
Thank you. Thank you.
Sure. That's it. Okay. Any
other questions? Ibrahimov, please.
Hi, hello.
Go ahead.
Yes. Yeah, go ahead. Yes.
Subrahmanyam, just had a quick question about what do you think about analogs of the results for cryptocurrency returns? There was some studies on predictive regressions for those.
What currency returns?
Yeah,
currency?
Analogs of the results for cryptocurrency markets.
Yes, I think that it's going to be very, very useful, Rustam, to do this study for currencies and other assets, commodities as well, because as we know, value and momentum everywhere is something that there's a paper on it by Asnes, Moskowitz, and all these guys. So, no, to my knowledge, nobody's done it. But I think that we'll see more and more studies of this nature as time goes on. But I think it's an important extension. I don't think anyone's done it, but I think we need to do them, yeah, to see if the result here is robust. Yeah, good extension. That would be.
Any other questions? So I will just ask one quick question. It's more like a curiosity, Professor Subrahmanyam. Your signal recall window is 11 months, which is like close to a year.
Yeah. Mm-hmm.
So if I were to understand how very short-term signals work, like 1 quarter, how do you think these results would pan out?
The scene on that is that momentum, unfortunately, works best when the signal is measured over 6 to 9 months, 6 to 12 months, let's put it that way. 3-month signals don't work very well for momentum. So my response to your reaction would be that if I use the 3-month signal, then the result will be weaker. So we're just going by Jagadish and Titman, who said 6 to 12 months is the best window to measure momentum return. So we went with 12 months. 3 months won't work, boss. I mean, if you look at momentum over that period, you won't get anything. You can try. So that's just previous work. We went by that. So 3 months won't work. I mean, I agree the methodology could be applied for 3 months, but I don't think that you would get similar results. It would be weaker.
So basically, I would not mind the negative result, like even if we lose the boxing matches, but then that would tell me that 1 quarter is not enough to accumulate signals.
Yeah. No, I'm not quite sure. I think you faded out, but I'm not sure. Could you repeat your concern? What exactly?
Yeah, I was just saying that even if we get a negative result, that we lose the boxing matches with only 3 months.
Yeah.
Then I would say that okay, 3 months is not enough for accumulating a signal, a meaningful signal.
I see. So what you're saying is that it's a good idea to report it and then rule it out rather than simply not report it. That's a valid concern. I completely agree with you. Yeah, I agree that we should consider that. Yeah, that's a good suggestion. Yes. I think that's a better approach. Yes, definitely. Thank you.
Well, so are there any other questions or comments from the audience? If there are no more questions, then I would like to thank Professor Subrahmanyam for a very enlightening talk. Let us all give him a big hand.
Thank you.
I would hope that you will remain involved with our conference even in future. Ask your students and collaborators.
I don't have to be a speaker, but I come to the South very often. So hopefully next time I can visit you in person. That'd be great. When I'm on my next trip to India anyway. Okay. Thank you so much for the invitation. Thank you.
Thank you. And with that, we come to the end of today's discussions. So tomorrow we will continue the program with the student paper competition. And we start at 2:30 p.m. Indian Standard Time. So the start time tomorrow is 2:30 p.m. So thank you all and a good day.
Thank you very much.